Welcome back to Trader UK, the money management channel. I'm back with another stock of the week. At the moment, I'm on the lookout for hidden gems, companies who you might expect to perform poorly in the current situation, but actually their business model is more suited than first thought, which means we're able to pick them up at a somewhat cheap price and most importantly at the start of a period of growth. And today I really think this is what I've got for you. Before we dive into this, you know the routine by now, but if you could smash the like button for me, I would be hugely grateful. And if you haven't already, then make sure you subscribe for more similar content. In today's video, I'm going to first tell you the company, and then I'm going to explain why these difficult market conditions could actually work to its advantage, hence why I'm putting more money into this stock. Now, today's stock of the week is called Upwork. The ticker symbol is UPWK and it's a NASDAQ listed company. They specialize in matching freelance workers with businesses or individuals that need freelance workers. And I like this one because on the face of it, it sounds like recruitment. Recruitment will traditionally not fare well in a recession type scenario. I mean, in these times, most companies are trying to reduce their workforce, not increase it. And so not a great time to be in recruitment, but the freelance market is different. I believe the freelance market is set to explode short term, and I'm going to give you 3 big reasons why this is the case. But first, let's take a quick look at the financials. Now, the company only listed in October 2018, so there isn't a huge amount of trading data available, but you can see since the IPO, it hasn't been the easiest ride for investors. If you pick them up after the IPO around $20 a share, then it was a long, painful 18 months watching the stock price drop. What's that, nearly 75% down to $5.40 a share at one point in April 2020. But since then, the stock has a new lease of life. They do already make up part of my portfolio. I picked them up about $11 a share originally, and now they're sitting around $15 a share. So let's take a look at why there seems to have been a turnaround in the company's fortunes. So let's look at the data for 2017, 2018, 2019 we have on screen. And there are some positive trends here. Revenue highlighted in green at the top is growing at a significant rate year on year, between 20 and 25% each year. Gross profit in yellow also growing. In fact, the gross margin improved a lot in the 2019 year. So you start to wonder, why was the stock price performing so badly across the same time period? And the answer becomes apparent when we look at the net profit or loss in this case, a little bit further down, highlighted in red. The company is still loss making. And of course, it's pretty worrying to see a company where the revenue is increasing at such a rate, but the losses are increasing at an even faster rate. This here, highlighted in red, this will be what's scaring off investors. Looking at the more recent results for 2020, the first quarter was good. Turnover was up 21% to over 83 million, and gross margin increased again. They were cautious though with their guidance. At this point, they gave guidance for the second quarter, and they estimated 79 to 81 million of revenue for the quarter ending June 20. But when those results actually came in, they were at 87.5 million, which is way, way above the estimates. However, it does seem like the higher the revenue gets, the bigger the losses became. In the same quarter to June 20, losses had increased to 11 million. That's 4 or 5 times what they were in the same quarter the previous year, which is a huge amount for a relatively small company like this. But why? They're just a marketplace, really. They have a similar business model to, say, eBay. They put buyers in contact with sellers and they take a cut. Plus, their cut keeps increasing, but somehow the bottom line earnings aren't. So you're probably still wondering at this point why I still like this stock so much. Why is it making stock of the week? And the reason for that is where they're spending all this extra money, which I've highlighted here in green. It's gone gone on R&D and it's gone on sales and marketing. That's where the money's going. This is nothing new for Upwork either. If you read the notes attached to the accounts, they've been plowing money into these two areas for as long as the accounts are available. But the approach now seems to be that everything we earn is reinvested and then some. Look at it here, 5 million extra on R&D alone in this quarter, 10 million extra on sales and marketing, and all of a sudden we know where these losses came from. Now, for me, this is much less worrying than at first glance. If we saw the fixed cost, maybe cost of revenue, increasing at this rate, it would set off the alarm bells. But this looks like a conscious decision the company has made because it operates in a competitive market. Sites such as Fiverr and Freelancer are a genuine threat to Upwork, but the heavy investment in R&D and marketing has positioned them very well as the number one in the freelancer space. So now as the market swings in their favor, they are going to be best positioned to capitalize on this. Which brings me on to 3 reasons why Upwork are in the right market at the right time. Firstly, companies need flexibility. You'll see some interesting KPIs in their quarterly results. One was that they're working with 30% of the companies in the Fortune 500. In times of uncertainty, these Fortune 500 companies, they're going to want flexibility, which is why they'll prefer freelancers to employees because there's less commitment. Nobody is really sure at the moment if these changes to consumer spending are permanent or if they're temporary. So the last thing a company who's performed well in the pandemic will want to do is hire tons more permanent staff, because what happens if demand drops off again? They get left with high overheads and potential redundancy costs. So they are much more likely to test the water for a while with the freelancer market, certainly in the short term anyway. Secondly, we're going to see more small ventures. Unlike most recruitment firms, higher unemployment levels could actually be a positive for Upwork. It means more solo projects, it means more people turning to self-employment, more small business ventures which need websites, they need logo designs and these types of things, which is exactly what the Upwork marketplace is there for. So I can really see Upwork thriving in a bad economy. And finally, we have government policy. The biggest risk for a freelancer market is always that the government turns against them. Most governments actually prefer people to be employed rather than freelancing, just as a general rule. It makes it easier to tax them, and on the whole, they can generate more tax revenue from an employed individual as opposed to a self-employed individual, certainly percentage-wise anyway. However, it's a balancing act for the government. The freelance market helps with innovation and it serves a purpose for flexible working, so they need to keep it. What they usually end up doing is making it more or less beneficial tax-wise to freelance, depending on how they want the balance of the workforce. Now, most economists are expecting a tidal wave of unemployment towards the end of this year, which in turn will see more people on unemployment benefits. And to get you off of those benefits, government will not care if you're doing that by finding employment or if you're doing it by freelancing. Providing they can stop paying you from the state, then you can start contributing again. So in my opinion, this is still a high risk, high reward situation. The company is still loss making at the end of the day, but for me, that looks like a choice made by the company to solidify their position, which I think will start to pay dividends soon. We can see from recent revenue results that the tide is shifting in their favor. With a market cap of just 1.8 billion, I like this one. Let me know your thoughts on it. Do you hold them? Is it too risky for you? Thank you for watching, and as always, I'll see you next time.